Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Here's what has our attention right now. First, the Federal Reserve has signaled that they will start cutting rates in September. The market is projecting the Fed funds rate will be cut by 1% by the end of this year and cut by another 1% during 2025. What we think is most important to recognize is these rate cuts are already priced in by the market. We do not think this can be used as a positive catalyst anymore to fuel additional gains for stocks. The other thing to remember is because so many homeowners and companies locked in lower rates on mortgages and business loans before the rate hikes began, the impact of changes in the Fed funds rate is less likely to be impactful to the economy as rates come down in the same way that it was less impactful during the rate hikes of the past 2 years. That could be an issue for the Fed if they really do need to stimulate economic activity in the future. As it relates to the stock market, rate cuts are not a guaranteed bullish signal. In 2000 and 2007, the Fed started rate cutting cycles to try to avoid a recession. It did not work either time, and a multi-year bear market ensued. That doesn't have to occur this time, but it's useful to know that rate cuts rarely save a slowing economy. There was an abrupt correction in the stock market at the beginning of August. Since then, stocks have bounced back to near all-time highs. It's a good reminder to not get too caught up in short-term moves or predictions in the market. No one has a consistent track record of predicting what will happen in the coming days or weeks. What we have recognized since the start of July is which sectors are performing well and which are not in the stock market. First, looking at the last 3 major bull market peaks, cyclical sectors tend to perform very well in the 12 months leading into the peak, while defensive sectors lag. Then, in the 6 months after the market high, the outperformers change. Tech and discretionary move to the bottom, while defensive sectors shift higher. That's relevant now because of what we're seeing since the midpoint of this year. Since July 1, defensive sectors like REITs, utilities, consumer staples, and healthcare, as well as other defensive assets like long-term treasury bonds and gold, have delivered high single-digit to mid-double-digit total returns. Meanwhile, consumer discretionary and the 2 tech sectors are trailing behind. It's similar to the sector breakdown around a market peak. What's also important to realize is these 3 lagging sectors make up about 50% of the S&P 500 index, while the 4 defensive sectors are only a little more than 20% of the index. We think there should be more balance in investors' stock portfolios at this stage of the cycle between the tech and discretionary sectors versus the defensive ones. One other sign of a slowing economy is weakness in commodity prices, and that is evident as well. We could post a chart of the CRB commodity index to show the broad-based weakness, but it's the bear market in agricultural commodity prices like corn, soybeans, and wheat that is most pronounced. This downward trend will reverse at some point, but for commodities more than any other area of the financial market, it's important to wait for a new multi-month trend to establish itself before jumping in rather than trying to time the turn. In summary, the Fed rate cuts are about to start, but it's not a guarantee that will be a positive for financial assets. The stock market has recovered from that recent correction, but it's the defensive sectors that are performing best, which tells us we may be near a market peak. And finally, other cyclical areas of the market, like commodity prices, are signaling weakness, which tells us we want to be very mindful of how we're positioned and make sure that our downside protection is intact. If you have any questions or would like to learn more about Oxbow, please contact us. We provide the information that we think is most valuable to investors. If you'd like to follow our work more closely, please subscribe to our YouTube channel.